Hello and welcome to BQ Prime. We're doing the special discussion on cement, and joining me is Hetal Gandhi, who is the Director of Research at Crisil Market Intelligence and Analytics. Hetal, thank you very much for joining us on BQ Prime. You're guiding in your note that cement prices are expected to fall by 1 to 3% in fiscal 24 after hitting an all-time high in the last fiscal. What are the premise for that assumption?
Yeah, so if you look at long tail data for cement, you will typically see that Q1 and especially pre-monsoon is the time when prices start showing an upward trend. More or less, they become like a benchmark for the full year price trends that you can expect. For example, FY23 April May we saw the prices climb substantially up to around 400 to 405 rupees per 50 kg bag. This time around, if you look at the Jan Feb March quarter and along with that the April May months, you will see the prices have remained more or less subdued. So that's clearly a cue that you may not see any meaningful increase in prices for FY24. Also, if you look at long tail data for cement, what we see is that most of the players want to capitalize on demand trends or demand push in pre-election years than gain more price trends. So combination of these two, we believe, is a good enough data point that supports our analogy that you may not see a sharp increase in prices.
If you look at the trend region wise, because cement is from more of a regional play, which are the regions where you're going to see higher pressure on pricing compared to other regions?
Sure. So I think South is clearly a market which generally sees a more higher price pressures. So you can expect almost 3% kind of a drop in prices on the southern side. Followed by that, you have East. There are a lot of capacity expansions which are happening on the eastern side. So, that would also be a market that may be under pressure as things stabilize over there. And relative to these two markets, West and North will comparatively do better with flattish kind of price trends.
If you look at last year's price trend, it was more or less similar there, right? Means there was an attempt to push prices through in the southern market and the eastern market, but they had to reverse it after a while because there was no takers for it. While there have been some success in the Mumbai market and maybe the eastern market or western market as we speak. Can you give us a sense of where is the pricing what do you call power coming in for some of the players? Is it the eastern market or the western market where you see some of the states going for election or towards the end of the year, and that's where you may be able to see some kind of pricing coming in?
Yeah, so I think elections is a mixed bag. A, you have central elections coming in next year. B, you have a lot of states where elections are lined up. You have some kind of elections which are there in Rajasthan, Maharashtra, Telangana, so Chhattisgarh, Haryana. So these markets, even AP, there is some action that is expected. So, these markets clearly where there is a good enough amount of infra push that is going to be there. So this clear, focus for cement players is that in pre-election years, they want to capitalize on volume growth. In fact, we are talking about a third consecutive year of very good volume growth. FY22, we saw almost a 9% growth. FY23 ended at around 12%. And even FY24, we are talking about 8 to 10% growth. Combination of these 3 years, we are talking about cement multiplier to GDP continuing to say above 1. In fact, it is almost like 1.5 times if you look at just these 3 years. So that is a good enough pocket for manufacturers to capture. On the other side, if you look at the raw material prices also, most of them are expected to come down. And given that, energy cost is a larger proportion for cement players, as we are seeing respite over there, that gives them that much more support to maintain prices.
I was coming to the input cost prices as well, because that's ebbed compared to last year, because because of the Russia-Ukraine war we saw a huge increase in energy prices. what kind of trickle down that will happen to the profitability of some of the cement companies and sector? I know you don't speak on company specific, but from a generic point of view, how much of that could trickle down to the profitability, because input is a big component of their expenses.
Correct. So if you look at overall profits, there was a sharp drop that we saw last year. As you rightly mentioned, there were markets where they were not able to hold on to increase in prices, and that with the higher raw material cost, especially on the power and fuel side of it, resulted into sharp drop in profits. We are expecting a V-shaped recovery from there on, while they may not be able to recover all the profit drops because the profits were also at all-time high by the time they reached closure of FY22, FY23, or middle of FY23. So you clearly saw a drop from those high levels. But if you look at trends, power and fuel cost that accounts for almost 35% of their total cost, went up by almost 65% cumulatively over 2 years of FY22 and 23. We are expecting almost a 14-15% drop in that cost. So is it going back to pre-COVID levels? Not really. But you are seeing a meaningful drop that is happening in that space, which will in a way provide some respite on the profitability side.
Hmm. Coking coal prices, how do you see that trend? Because we've seen softening of those prices as well. And do you see that also, helping better, realization per bag per ton for some for the cement companies?
Yes, both coal and petcoke prices, we are expecting a drop. For coal, we are clearly seeing that there is a moderation that has happened. We again do not expect the prices, international prices going back to pre-COVID levels, given the supply chain uncertainties that exist. But recoveries on the demand side for key categories which are users of coal have not happened thanks to lower than expected recovery that we are seeing in China as well. So, that is definitely going to keep coal prices under pressure. 15 to 18% is the range that we are working with. Petcoke, a similar trend is what you can expect with lower crude prices. So, combination of these two will result in your power and fuel cost per ton going down from almost 1600 rupees per ton to roughly 1430, 1450 levels.
Hmm. Is it fair to say then the top line would be driven by volumes and not much price, but the profitability would be driven by correction in input costs, largely input costs for the cement companies?
Yeah, so two things which I would like to highlight. Yes, you are right that demand is clearly, or the volume growth is a driver of the revenue growth rate. Profitability, I would say the lowering raw material cost and the scale benefits that you will get, because if you look at say FY19, which was the pre-COVID year, your utilization levels were at 69%. And that in at the closure of FY24 are going to be somewhere around 70 to 72%. So you are reaching utilization levels which are very, very healthy for cement players. So combination of both these things will result into better profit.
You spoke about the fact that scale is coming up for many of the cement companies and across regions. Uh, can you give us a sense of which region is going to get the maximum capacity? Coming in the next 2 or 3 quarters, where all the number of capacities or commercialization of those capacities are going to kick in, basically.
So large percentage of the capacity additions are happening in the eastern region, around 10 to 12 MTPA is what you can expect in FY24. That has also been the trend over the past 5 years, where average capacity additions that have happened between FY19 to FY23 would be upwards of 15 MTPA each year. In the central region also, we are seeing almost 9 MTPA worth of capacity that is getting added. So clearly, both of these combined together itself are adding around 20-21 MTPA worth of capacity. You will see the northern and the southern regions having almost 6 to 8 MTPA worth of capacity additions, and west would be the lowest with 5 MTPA. So that would also inversely then reflect in a way in utilization levels. Your utilization levels in east reached almost 70% in FY23. You will see a drop over there. because huge capacities continue to get added. On the other hand, southern region, while there are capacity additions that are happening, capacity utilizations will continue to improve. They have been at fairly low levels of, around 55% on an average in the past 4 years, and would be reaching around 61, 62%. So that's a, good sign in terms of holding up the prices. Central region will have stable capacity utilizations of around 73 odd percent. I think northern regions will continue to see an improvement in utilization levels. Utilization levels there are at a peak of almost 80%.
What about the demand scenario in these regions? Means are there enough demand coming in to absorb this additional capacity?
Uh, yeah, so utilization levels are a function of demand. So we do see that demand is remaining healthy more or less across, except for the eastern region. No other region is seeing a drop in capacity utilization levels in our workings for FY24. So that tells you the story.
Last year and last 2 quarters, we saw that there was enough demand coming from infra projects, but real estate and household construction was pretty much slow to take off. Do you still see that going happening in FY24? Demand mainly been pushed by infra and the household construction, real estate, and others. Taking a slower growth path.
So structurally, if you see, yes, in a pre-election year, both state and central, you will see the completion pace of infra projects being very, very high. And therefore that will drive. On the housing side also, there are projects which are driven by the government, which is like the Pradhan Mantri Awas Yojana, both PMAY, Gramin as well as urban, we have seen very good completion percentage. Gramin, in fact, shows almost 77% completion. Urban is showing 67% completion, but pace will now pick up faster over there, given that state elections are also there on the agenda. So a push will come from the state government also to ensure that if specific infrastructure is not available for the construction or there are bottlenecks, they are being cleared. Central government funding is something that will remain a monitorable for PMAY by urban, but we do believe at an overall level, whether it is PMAY, whether it is Sagarmala project, metro projects, which are leading projects which are happening, or road projects, we are pretty optimistic that infra will be the front runner in terms of overall growth rates. So if you ask me exact numbers, infra that accounts for almost 30% of the total cement demand should grow at around 10 to 11%. Sorry, 14 to 15%. And if you look at housing, rural housing will continue to grow at around 6 to 7%. Urban might be a 5 to 6% kind of a growth, which is how the numbers would stack up.
This is compared to 8 to 10% volume growth that you will see in FY24, to put it in perspective, right? So infra,
Yes.
1.5 times the growth of the industry growth rate or volume growth rate which you're looking at.
Absolutely.
Hetal Gandhi, thank you very much for joining us on BQ Prime today. Thank you.
Thank you. Bye.